The initial phase of a financial journey is primarily focused on survival. This stage prioritizes ensuring all essential bills are consistently covered. The main objective is to meet immediate financial obligations. Establishing a baseline of financial stability is crucial during this period. This phase lays the groundwork for future financial security and growth. Asset stabilization is a crucial financial step taken after fulfilling basic survival needs. It involves securing assets to protect them from immediate risks and potential losses. This process ensures that existing financial resources are preserved and maintained. Stabilized assets form a secure and reliable foundation for future financial endeavors. This stability enables subsequent growth and strategic financial planning without undue risk. Consistent and sufficient income flows mark a significant financial milestone. This consistency removes immediate financial pressure and a sense of urgency. The role of money transitions from mere protection to a more potent function. This shift redefines the individual's relationship with their financial resources. Initially, money serves as a fundamental protective shield against life's hardships and uncertainties. It provides a crucial buffer, ensuring basic needs and offering a sense of security. However, this primary function shifts once a solid foundation of financial security is established. At this point, money transcends its role as mere protection. It transforms into a powerful tool, gaining new utility as a means of leverage. This fundamental alteration redefines its function and expands its potential impact significantly. Leverage fundamentally alters the landscape of financial engagement. It represents a strategic tool for enhancing financial capabilities. The acquisition of leverage enables more dynamic maneuvers in financial markets. This mechanism grants greater control over potential financial outcomes. It signifies a substantial evolution in an entity's financial capacity. Leverage empowers entities to achieve objectives that would otherwise be unattainable. Financial security is a state characterized by a defensive posture in managing assets. Its primary objective is self-preservation within one's financial standing. This concept focuses on safeguarding existing assets from potential risks or losses. It prioritizes the maintenance of a stable and safe financial position. The core principle is to protect wealth rather than aggressively grow it. Financial power extends beyond mere economic stability or personal security. It represents a strategic capability for individuals and entities. This power enables the exertion of significant influence within financial systems. It allows for the active shaping of financial outcomes and market dynamics. Financial power transitions from passive safety to active engagement and control. This strategic capacity is crucial for directing economic trajectories and achieving objectives. Capital's transition from security to power marks a pivotal shift in resource deployment. Initially, capital is consumed by essential survival necessities, ensuring basic stability. Once these fundamental needs are met, capital is no longer tied to mere survival. It then becomes available for strategic deployment towards growth opportunities. Opportunities, when strategically pursued, exhibit a unique growth dynamic. Their multiplication rate significantly surpasses that of basic necessities. This accelerated growth is contingent upon the availability and application of capital. The interaction between strategic opportunities and capital creates a compounding effect. This compounding effect is a key driver for wealth accumulation. It also leads to an amplified increase in influence over time. Financial leverage is a strategic approach to capital management. It involves positioning capital to enhance its impact and potential returns. This principle is not synonymous with reckless borrowing or excessive risk-taking. Proper understanding of leverage is crucial for its effective and sophisticated application. Strategic leverage involves using capital to acquire assets. These assets are typically undervalued in the current market. The acquisition aims to capitalize on their unrecognized true value. This strategy allows for potential financial gains. Gains are realized as the market eventually recognizes the asset's full worth. Strategic leverage involves a precise market entry approach. This strategy targets periods of widespread market pessimism. It is a counter-cyclical method going against prevailing market sentiment. Such an approach allows for highly advantageous entry points. These opportunities arise when other investors exhibit hesitation or fear. Capitalizing on low sentiment can lead to significant gains as markets recover. Economic contractions often lead to market instability and asset devaluation. Many entities choose to divest assets during these periods to mitigate losses. However, organizations with strong financial reserves can adopt a counter-cyclical strategy. This involves strategically expanding ownership when asset prices are typically more affordable. Such an approach allows for significant growth opportunities at reduced acquisition costs. This model leverages downturns to strengthen market position and long-term value. Strategic leverage involves investing when others exhibit hesitation. This approach requires robust financial reserves to capitalize on market conditions. A deep understanding of market cycles is crucial for identifying opportunities. Downturns, often seen as risks, are transformed into strategic investment opportunities. Such counter-cyclical investment is a hallmark of informed and disciplined financial strategy. Economic downturns often present significant challenges and risks to businesses and individuals. However, for entities with robust financial reserves, these periods can transform into unique advantages. Such situations create asymmetric opportunities, where potential gains outweigh the inherent risks. These opportunities allow for disproportionate returns relative to the capital invested or risk taken. Strategic deployment of strong financial positions during downturns can lead to substantial growth. Economic cycles are inherent fluctuations in economic activity characterized by expansion and contraction. Historically, these cycles have been a source of uncertainty and concern for many market participants. However, for entities with substantial financial power, the perception of economic cycles shifts. These cycles are no longer viewed with fear, but as predictable phases within the market. This perspective allows for the identification of unique access points for strategic investment. Such strategic engagement aims to capitalize on market dynamics for sustained growth and advantage. Wealth building often begins with participation in existing economic structures. Early stages typically involve owning shares in companies or other assets. This initial phase focuses on gaining a stake in established systems. As wealth progresses, the focus shifts from mere participation. The later stages emphasize acquiring direct control over systems and structures. Owning systems implies a deeper level of control over assets and processes. This control can manifest as equity in scalable businesses, offering significant influence and returns. Intellectual property rights also represent system ownership, providing exclusive control over creations. Real estate generating durable cash flow is another example of owning a system for consistent income. Automated digital assets exemplify modern system ownership, operating independently to generate value. Strategic ownership represents a distinct approach to wealth creation, differing from passive investment. It involves a proactive stance, moving beyond simply holding assets. This method often leads to an accelerated compounding of wealth. The core of strategic ownership lies in active management of assets. It also encompasses exercising direct influence over the owned entities or investments. This active engagement drives value creation and enhances financial returns. An anti-fragile financial structure is designed to thrive amidst volatility, not merely survive it. Unlike robust systems that resist shocks, anti-fragile systems gain from disorder and stress. This means actively benefiting from market fluctuations rather than being harmed by them. Such structures are engineered to strengthen and improve when exposed to variability and uncertainty. They leverage unpredictable events to enhance performance and resilience over time. An anti-fragile financial structure is designed to benefit from shocks and volatility, not just withstand them. Key components include diversified global exposure to mitigate localized risks and capture broader opportunities. Maintaining high liquidity during market stress is crucial for operational continuity and strategic maneuvering. Minimizing structural debt reduces vulnerability to interest rate fluctuations and economic downturns. Flexible asset allocation and disciplined reinvestment strategies enable adaptation and growth in dynamic environments. The concept of wealth often focuses solely on monetary accumulation. However, the ultimate multiplier of wealth extends beyond just money. It encompasses the principle of time autonomy, a crucial element of true prosperity. Time autonomy signifies a state where one's income no longer dictates their daily schedule. Achieving this freedom leads to significant improvements in mental clarity and strategic thinking. This allows for more effective decision-making and a higher quality of life. Long-horizon investors operate with a significant competitive advantage in financial markets. This advantage stems from the scarcity of patience among market participants. Most investors focus on short-term gains, leading to intense competition in that time frame. By contrast, a long-term perspective spanning 5 to 20 years reduces competitive pressure. This extended view allows for strategic decisions unburdened by immediate market fluctuations. Financial power is defined as optionality at scale, granting significant strategic flexibility. It provides the ability to enter markets during crises, capitalizing on opportunities. This power enables funding innovation and supporting long-term projects without constraint. It allows organizations to operate independently, free from external pressure. Ultimately, financial power removes desperation from critical decision-making processes. Financial sovereignty signifies a state where one's money actively generates further wealth. In this state, time becomes an asset, safeguarding and growing financial resources. A robust financial structure provides stability and sustains long-term prosperity. This eliminates financial fragility, dependency, inconsistency, and limitations. Wealth is transformed from a mere resource into a strategic instrument. Ultimately, financial sovereignty serves as a pathway to achieving ultimate freedom.